Welcome to the Manitoba Ag Days podcast, where we hear from some of the most relevant, up-to-date, informational speakers in our industry. In episode 14, Earl Anderson, President, Pro Market Communications Inc., tells his story, making sense of the dollars and cents.
Thank you. Thank you, Scott. Well, one thing I wanted to start off is thanking Brandon and the Ag Days Committee for inviting me. This is the first time I've been here, and I'm totally impressed. I have to admit, I got on the WestJet flight this morning. It said it was an hour late, and I went, oops. And but then I met my good friend Tony from England on the plane, and he's joining us today. So we're going to have an interesting few minutes. Markets. How can I word this? They are one of the strangest creatures that I've seen in my career right now. And the reason I'm saying that is because the economics of supply and demand are pretty much out of the window. And this all started way back in 2008, 2007, in the financial crash. And that has not gone away. So today, some of the things you may agree with me, some of the things you're not going to agree with me. But let's just pretend we're at a cooking show right now. And I thought, what's the best way to go into a subject that is not making a lot of sense right now with Trump and issues in the world? Well, it's a big pot here. Let's fill it halfway up with global debt. Okay? Then, let's take some central bankers and sprinkle it on top of this pot. And all of a sudden, there's a little bit of fizzing going on. And what they're doing is they're money printing. Okay? We're in the biggest money printing period since 1937, right now. Central bankers call it stimulus. It's not stimulus, it's money printing. But it's created tremendous asset bubbles out there for various segments. But in our field, in agriculture, we've seen commodity prices, they're limping along, right? The Dow Jones today went over 26,000 points. So what the heck figures? This pot that's bubbling under there with all this debt, and, oh, by the way, I forgot to sprinkle a little pinch of Trump in there, right? Oh, what the heck, let's put the whole jar in, huh? Okay, let's stir it. It's feeling kind of tar-like right now. Well, this is the top of that pot. Everybody thinks everything's perfect. We have got no volatility in these markets. It is the most unusual aspect over the past year is, we call it the VIX. It's the volatility index. The VIX is doing nothing. And the investors are absolutely fearless. Now that cat's been sitting on that railing on that apartment building for quite a while. And that cat is still sitting on that railing today. What's going on? A few years ago, about 3 years ago, I went to New York. My wife convinced me she wanted to go to New York. We went to New York. But at that time, the U.S. debt clock, we were right off Times Square. It was going at $9 trillion at that point. No, I'm sorry. When Barack Obama started, it was at $9 trillion. When we saw it in Times Square, it was $14 trillion. And today, it's over $20 trillion. Now, that's what $20 trillion looks like. Those are $100 bills. That is the Statue of Liberty, which is 250 feet high. That's about 200 feet high by half a block by 1 block. And the U.S. government has to service that. And they're increasing rates so that their service charges are going even higher. So we've got an amazing debt process going in the U.S. One of the aspects I look at outside of agriculture is the bond market. And right now, in the U.S., 10-year bonds, Treasury yields, their yields are coming down to 2-year. In fact, if the U.S. keeps increasing rates, they're going to invert. Now, that is a precursor to a recession. It happened in 1998, it happened in 2006, and it's happening right now in 2018. There is an incoming recession to the U.S., even though the Dow Jones is at 26,000 points. In fact, I thought 25,000 by Christmas. I thought, really? It is what, January 16th, and we've leaped another 1,000 points on the Dow Jones. Doesn't that remind you of the wheat market a few months ago? Minneapolis wheat, straight up, right? It's a bubble. So we have a stock market rally, and it's created by lower corporate taxes. And that's what Trump has done. And the market loves it. The lower corporate taxes, they're just running with a ball right now. We've got less regulation, we've got corporate stock buybacks, and we've got this thing called QE, investors parking money into equities. And the money flow is, it's just like a game of Monopoly. If you've got the railway company available for sale on your Monopoly board, but you got 10 times the money on the sidelines, what happens to the price to the railway company? It goes straight up. And what QE has done, or money printing, or bond purchases, is it's flooded the market with liquidity. So that market has to find somewhere to find a home. And that home is the U.S. stock market. There's Alan Greenspan. This was a picture of him in 2008 when he said the banks have exuberance, too much exuberance going on there, irrational exuberance. And what he was saying is that the banks should control themselves. Well, they didn't. They didn't control themselves at all. But this same venture right now, I'm viewing that for the U.S. equities. So I'm going to try to tie this in how it affects the commodity markets. This is the Dow Jones. Printed that 2 days ago. It's already out of date. It's a lot higher than that now. It's going into a blow-off top right now. Now, I listened to Jim Cramer on CNBC this morning, and Jim Cramer says we're going to 30,000 points. And why is that? It's a big number, right? It's a big number. Warren Buffett, he says the stock market's a buy all the way. How can you argue with Warren Buffett? He's the guru of gurus when it comes to making money. But we have a real massive market going on. So what are the emerging factors? Well, number one is NAFTA. What the heck's NAFTA going to do? Sorry, I'm going to drink a little bit as I go through here. To me, NAFTA is 3 sumo wrestlers circling round and round. But they won't engage. They won't engage. Even if President Trump does sign a written notice saying that the U.S. is going to leave NAFTA, a 6-month written notice, it probably ain't going to happen. It's got many hurdles. It's got to get through their Senate in the U.S. Congress. And there's a lot of barbs that are going to occur. So my opinion on NAFTA is the 3 sumo wrestlers are going to continue to go round and round and keep staring at each other, but they won't touch each other. That's my view right now. Now, I can be dead wrong on that. Tomorrow, Trump could say, we're out of here, and it's over, and everybody agrees, and Canada's in trouble. But I don't see that. I really don't. India duties. What's going on there? Well, that's really affecting us, isn't it, on the pulses right now. And the India duty situation, again, I think is at a standoff as well. It's going to be around for quite a while. I don't see much of a change right now. You know, India is trying to be self-sufficient, so we need a weather scare to get us out of that. Now we've got this massive crude oil recovery. And why is that? Why is crude oil suddenly, the Brent crude oil in the North Sea is going over $70 a barrel? The West Texas is going over 65 or thereabouts. Well, it's because of Saudi Arabia. Saudi Arabia drove the price down thinking they could squeeze the world out, And then they realized that the US was pretty darn good at fracking. And suddenly Saudi Arabia was going broke. And suddenly Saudi Arabia's royal family had issues with that, because that affects them as well. So Saudi Arabia now is doing everything they can to reverse all the damage they did on the way down to push crude oil back up. That's my personal feeling. And again, it's because competition got to them. And they started running out of money. Can you imagine that? Saudi Arabia, at this pace, would be broke by year 2020. Can you imagine that? No, you don't hear that on the news very much. But it's true. Canada's recovery or not, to me, we're being led by government deficit spending. No more and no less. We've had excellent job numbers. We've had the economy's boosting up, but at the same time, our debt is moving up as well at the same time. So there's a trade-off on debt. In Alberta, where I'm from, the Alberta government's going to borrow another $37 billion. We used to be debt-free. It is spooky in my province right now. I don't know what's going to happen. I feel sick about it. Our credit ratings keep going down. That means we have to pay more to service the debt. It's a pretty bad situation in the province of Alberta right now, even though the press says that we're leading the country in growth. We'll see. Okay, this is where I get into trouble in talks, because this is my opinionated opinion. We're at the end of an 80-year business cycle. I'm making no bones about this. And it's been already extended 10 years by central bank manipulation. Like what happened in 2007 should have created a crash. It really should have. But the central banks came in there, they started going money printing. Like the world was essentially going to go into a depression. And it has been delayed. Now, where I disagree with central bankers is I believe true economics always rules. Meaning, central banker, you can do whatever you want manipulating the market, but when it comes to supply and demand, it'll take you down. And it's starting to take down central bankers right now. Central bankers are losing power right now. Like, for instance, Ellen Greenspan and Ben Bernanke were more powerful than Janet Yellen. But Janet Yellen is going to be more powerful than Jerome Powell. That as their weapons have all been shot in the sky, they've got nothing left, they're in a bit of a panic right now because they have to increase interest rates in order to fight the next recession. That's why they're pushing them up, so they've got ammo to cut them in the next recession when they start money printing again. You don't hear that on the radio. But that's exactly what the central bankers are doing right now. So we've got three major bubbles in the US, at least in my career. And they are, number one, the dot-com bubble, 1990, or around the year 2000. Mark Cuban sold his company in 1999. It was good timing. It's all about timing when it comes to making money, isn't it? Bubble number two was the housing mortgage bubble in 2007. And if any of you get a chance to watch The Big Short, that movie to me is priceless because that tells a story. Because really, the fraud that went on in Washington, in Wall Street, was immense, but not one banker went to jail. Not one. Sorry, knocked my ears off here. One poor guy, sorry, I lost it. One poor guy in Turkey lost his job. That was it. Can you still hear me? Yeah, you can. Okay. Number three is the QE bubble. And the QE bubble is what we're into right now. And the QE bubble is the money printing bubble. Excessive money printing, what I call a global currency war. And this bubble is now 3 times larger than the housing bubble and the dot-com bubble combined. Thanks. I'll keep my hands stable. Western Canada. I'm from Calgary. Calgary is really hit. Downtown Calgary is 35-40% empty. Towers, empty towers. Brand new towers that were just built. One oil company there was one floor that one company had, or one tower was 32 stories. There was one oil company on story 27, and the rest was vacant. Like, that city has to reinvent itself. Now, it will. It will. It's going to go into the tech world. It will come about. But it will never go back to where it was. Not as long as I'm working right now. We have some major issues in that province. So what's the big problem? It's government debt, it's consumer debt. And right now, both of them are record-breaking. So even though the stock market is going over 26,000 points, everybody spent out on their credit cards for Christmas. You hear that on the news. Oh, we had a great Christmas. By the way, Joe's going to take about 18 months to pay it off. Everybody is so tight on credit. You probably heard in the news recently that how many families are down to their last $200 every month? It's like a third of Canadians. Like, that's not a good sign if we see any break in the market. So what's going to happen, in my view, is we're going to have company survival challenge. We're going to have corporate mergers over the next 3 to 5 years. The S&P index, which is a major index in the US, is going to go in for a makeover. I would dare to say that half those companies on the S&P are going to disappear. We're going to have a real shift. Now, we're not seeing any shift right now because the bubbles are still doing this. We're still moving up, right? Everything's hunky-dory. But we're also going to see the continued struggles of brick and mortar, in my view. Now, everybody's blaming the brick and mortar problem to online shopping, and yes, that's true. But it's a little deeper than that. Consumerism in the US is 70%. 70% of the American economy is buying stuff. Whether we need the stuff or not, we're buying stuff. But that's a key driver, and that's got to keep the wheels going in the US, is that consumerism drive. Any tip in the consumerism will start to tip them back down eventually. Now we have the US corporate tax cuts. And we've got the tax cuts, which the market is absolutely running with the ball right now. Now, this is interesting. The tax cuts are through, but the infrastructure is next. And, the US needs airports, the US needs bridges, the US needs highways. That's where it's going to get a little sticky. Because I think the push was to get the tax cuts in, and now there's a lot more money out there. Another $1 trillion is needed to start repairing all this infrastructure in the US. So to offset that, the US Federal Reserve, they're going to gradually unwind their balance sheet. And their balance sheet right now is $4.5 trillion. I can't even imagine what that is. That's a lot of money. That's about the same size as American GDP. And what that means is that's the support that the US Federal Reserve is lending to the US economy to keep it going like this. Now they have to start to unwind it. They bought bonds to basically create money printing. Now they have to sell bonds to start unwinding this thing. Now this is going to take a long time. Plus, they want to increase rates 3 to 4 times in 2018. So not only are we chopping at the knees, we're cutting off the other arm. So that means the training wheels are coming off. So this, 2018, this is the year the training wheels are coming off. So that means economy better be doing good, and it better be able to hold right now. So the true test over the next few months is when these decisions are made. Now, in my personal opinion, there's not a hope in heck this is going to happen. It's easier to talk the talk than walk the walk. And I can be pointed at as well for saying that, but Every year, they're going to increase those rates 3 to 4 times, and we get 1, 2, something like that in the marketplace. I don't think it will happen. Also, if the U.S. starts to go like this, suddenly they will stop this unwind. They will not start, they'll halt that. In fact, they'll go into QE4. That's more money printing. They had QE1, QE2, QE3. QE4 will be born if the U.S. goes into recession. Forget about the interest rate hikes. Forget about unwinding the bonds. We need more money. So this will be very, very fascinating as this unfolds. So new normal, my favorite friend. New normal is prolonged, slow economic growth. We're not going to get around that. And why aren't we going to get around that? Why can't we bust into 4% growth, 5% growth that Trump is talking about? Well, it's because of debt. Who's paying the bills? It's debt that's holding us down right now, and it's really music. And this massive debt load, I think, is going to be very, very restrictive to the recovery of global economies. So, Mr. Bean, I think you got it right there. But we look at Dr. Copper. Let's get into our world. Commodities. Dr. Copper, where copper is a reflection of global economies. And what's happening there? Well, copper actually has been starting to rebound right here. Now, this was the election right here. And you can see why it popped up there is Trump's promise of infrastructure building. And that's, everything's made in copper. Copper's in everything. So that really started to move us up. And then we are seeing some European growth gains right now. So we're seeing a little bit of European gains. The US is rolling at the moment. Asia actually is starting to turn back down right now. Like China's starting to turn back down. Japan is starting to turn back down on that side of the ocean. That's affecting our markets here at home. It's even affecting canola. That turned down in Asia right now. This is a swear word to a central banker. Now, the reason I say it's a swear word to a central banker is because the central banker has no control on deflation. They can manipulate inflation. They've got the tools to work on that. It's easy to put tools on inflation, but if prices start to go down, a central banker is hooped. You never hear them say that word. They'll say disinflation. Janet Yellen will say disinflation and transitory. Transitory means temporary. I hear that in her speeches all the time. But you'll never hear the word deflation. Deflation is hitting you right now in commodity worlds. Where is this money going? Okay. Interest rates aren't giving us any money. Where is this? We've got this liquidity. We've got this monopoly table that wants to buy the railway company, and they're going to pay a fortune for it. But where is this money starting to flood into? Well, it's going into things like art. It's going into things like classic cars. Barrett Jackson, look how popular it is right now. Money is flowing into these other aspects. It's going into luxury real estate, New York condos, LA. That's why these shows on reality TV, $1 million listings, are doing so great, because everybody gets their price plus 10%. Because the liquidity problem that I see in the world, it's flooding into these markets. And then we have Bitcoin, which I have no idea how that works. The only thing that I picked up is Warren Buffett said the other day is the ending for Bitcoin will be very, very bad. I thought, well, Warren, I agree with everything you say, so I agree. I don't know why. I don't even know what it is. The thing I hate about Bitcoin is it's money laundering. Okay? Criminal world, I don't like that. That's an avenue for unregulation. And I don't know how it's going to pan out. But the CME has Bitcoin futures. ETFs are going to start coming out. And I don't think anybody really knows exactly how we're going to work on this, because can you imagine paying a loaf of bread with Bitcoin? By the time you trade it into cash, it might be worth double or half. So how do you control the volatility in a product like that? It's because I don't know anything, really. I don't really know what it is. And then you have North Korea. What's going to happen there? You know, that cat was on the railing there, holding there just calm, and some weekends there was threat of nuclear war, but the cat just kind of hung onto the rail. I've never seen that before. In the old days, if we had any hint of geopolitical tensions, the stock market would go doof, doof. Now the stock market just does this. And does that look like a normal canola market? Just up, and up, and up. Does that look like a normal cattle market? It's being supported. They aren't normal markets, in my view. They're not normal markets at all. Then you have negative European rates. Do you know that the European Central Bank has been printing as much as 80 billion euros monthly? And then they cut them down to 60 billion, and there's no inflationary response. That says something. There's a economic theory called Keynesian theory, and if you go to economic school, all you hear is, when Reagan was in power and the U.S. started going recession, he printed money and it worked. But Reagan's debt was this big. The debt now is this big, and printing money doesn't work anymore. That's my personal view. A lot of people will disagree with me there, because the world is based on Keynesian economics, which is now failing, and central bankers are using nothing but that economic policy. Do you know that the US Federal Reserve has 1,000 PhDs all nodding to each other saying, yeah, this will work? And it's not working, in my view, because they're going after failed economic policy that we're taught in school. Okay, I'm not getting back into any university because no university is going to invite me back. But that's my personal opinion from experience out in the working world. So central banker powers, in my view, are fading, meaning that the next time the market turns down, there's no bullets left. Okay? There isn't any bullets left. Like, they have shot them all. Like, there may be QE4, but there's not that many bullets. So, as I mentioned earlier in the presentation, it is the ghost of 2008 that's still under this market. It hasn't gone away. The day they took that Lehman Brothers sign down in Wall Street, the day they took that Bear Stearns sign down in Wall Street, that was the end of financial times. Like that, the world market was, at that point, for the most part, destroyed. And now we're getting to a situation where, yeah, we're starting to build, but there's these demons on the sideline that will come in and kind of nip us. But we have these asset bubbles that are just flaring right now, like crazy, like in the stock market, in art, in those type of asset bubbles that continue to move higher. Now, what's bothering India? It's because they had so much counterfeiting on their currency. They had to do something about it. So Modi decided, well, we got to replace our bills. And he said that, you got $30,000. Well, if you want to get the new bills, you have to bring in the old bills and we'll replace them with new bills. So what happened to all the criminal money? It suddenly flushed it out. But it made rural India poorer. It hurt rural India because a lot of them don't have bank accounts. And they were not getting paid. They were getting paid by IOUs because there was no currency out there. Like, they didn't have debit cards. They didn't have credit cards. And that's hitting us right now. That was the start of the duty problem back there because it created a lot of grief in India. And then you've got China's impact. Now, China, about 2012 was the top of their bubble, and they were growing at 14% a year. India right now has moved down to about 6.5%. 6.5% in China is approaching recession. It's crazy, huh? Like, you hear about all these Chinese cities that are empty. You see with 60 Minutes, they had a special on it. Cities that can hold 1 million people, there's not a soul there. And then they're starting to knock them down again. Sound weird? Well, that's China's form of QE. They're not money printing, they're putting their people to work. If we have to put up a skyscraper and then knock it down, well, at least they're getting money. And it's their form of QE, in my view. So even though we may say, well, what's China doing with these ghost cities? It's no different than the US Federal Reserve having a $4.5 trillion balance sheet. It's the same difference, except they're getting their people to work. So what's this mean to us? Demand is king. You know, in economics school, we're taught that supply and demand equals price. Don't work that way. It's the guy or lady that has a checkbook that creates the price. So the reason I bring this up is that even though our supplies may tighten, prices may actually go down. Weird, huh? And that's something I'm just going to put in the back of your mind, because when we have rallies, and you will have grain rallies ahead, it's just that they'll go up, 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 and then all of a sudden, though, they'll go down, 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 down. And we're going to see it, this whipsaw effect, because it's a very demand-driven market. So the US Fed wants to move those rates up. They won't. They want to attempt to normalize them. They won't. The word normalized by the Fed, I almost have to laugh about it. There's no way they can normalize those rates. No way. They can try to creep them up a bit, but they will not normalize them. US dollar. Okay. If the US was doing really good economically, shouldn't the US dollar be flying higher? It's the US dollar. It's dropping like a stone right now. What's happening there? Well, it's because the market is calling the Fed's bluff. They're saying, hey, you said you're going to hike rates 3 or 4 times, and that should bullish up the US dollar, but the market's figuring it out. Uh-oh, now they're only going to hike it twice in 2018. Like tomorrow, the Bank of Canada is supposed to hike rates, right? Bad move in my opinion, but nobody cares what I say. But the Bank of Canada, if they do not hike rates tomorrow, our loonie is going to plunge. Be interesting. It'll be really interesting, because right now everybody's saying, BNN keeps saying, and I heard it this morning, 90% chance. Okay? Maybe they do hike it. But they're hiking it when consumer debt is at highest levels ever. And we got a third of Canadians down to their last $200 a month. Does that make sense? Do you want to knock Toronto house prices down further? Toronto house prices are down 7 months in a row now. Do you want to just crush the Toronto market? Because you could. And the Vancouver. All it takes is you start pushing it up. If the rates go up, in my mind, if rates in the United States and Canada go up about 0.5% to 0.75%, guaranteed recession. That's how finely tuned we are. Like, we cannot hike rates. We cannot go back up to 10% interest rates. And when I hear that on the radio, on Bloomberg or whatever, I personally just chuckle. There is not a hope in heck that the central bankers can hike rates like that, in my opinion. Gold. Okay. If you look at the internet, gold's supposed to go to $5,000 an ounce, right? It's not going to go to $5,000 an ounce. And why is that? Deflation. Gold needs inflation to move higher, not deflation. Also, India is a major physical buyer, and they are not purchasing gold to the same amount as they normally do. So we've got India backing off. You've got deflationary pressures. To me, on the gold market, right around that, right where we are right there, about 1350 to 1375 is the top of that range. Like, if it does bust out, I guess there's a cause for it to go up to 15, but in all honesty, I can see it going right back down to 1200. I think we're just range-bound on gold. That's my personal feeling. And silver just tells the whole story. Right now, silver, I believe, will stay pretty much range-bound. It will hold a deflationary tone on that market. So is the Canadian dollar bullish or bearish? Okay, well, we're moving up. And why are we moving up? Weren't we supposed to go down to 72 cents? Heard that on the radio lots. It's because the US dollar is falling apart. That's why. And the Canadian dollar, quite honestly, is going up by accident, in my view. albeit we had super duper job numbers here for the month of December. But can they be repeated in January? No. Not a hope. Not a hope. So we're going to see, albeit we're going by, in my view, market osmosis. Because when the US dollar goes down, money floods to other avenues. And the loony's sitting there, and all of a sudden it's getting money. And that's why it's going up. Now, the other talk, of course, is as the Canadian economy being so good that interest rates will continue to go higher. So tomorrow, we'll find out if we get a rate hike or not. So we had 2 rate hikes of 0.25%. Right now, we're sitting at 1%. If we do get a rate hike tomorrow to 1.25%, it's one and done. That's it for 2018. We'll see how life is in 2019. That'll be the end of that. The crude oil range, in my view, is moving higher up into that 55 to 65 zone. Again, that's Saudi's push. And we're seeing quite a remarkable move. Now, with the crude moving up like that, we should see the Canadian dollar. If we're at $65 crude, in my head, our loonie should be probably 82 cents. So that's kind of my personal target on the loonie. So where are grain markets going? Corn. We see the equities doing this, right? And then we go to our world, and we get this. Corn is like watching paint dry right now. There is nothing happening. This market is holding at around 350, but we had a USDA report here the other day that just didn't give us anything. So in all honesty, I think we're going to go a little bit lower. In my personal feeling, unfortunately, I think the corn's going to go down to maybe around $3.35 a bushel, another 15 cents lower. Now at that point, it's got to be a buy. These grains are getting so low. Feedlot bids in Alberta. Actually, what might interest you here is that our barley bids are holding around 219 to 221, a little bit of a road band premium there for April. But Manitoba, there's a lot of Manitoba corn coming into southern Alberta. In fact, it's preferred because those cattle are getting fed on corn and they're getting shipped to the States, and the States likes corn-fed animals. So, we're seeing anywhere from 500,000 tons to 1 million tons of corn from both the States and from here being landed. Kansas City wheat, that's Russia. And that's Russia all the way. The Black Sea now controls the global wheat price. Now, unfortunately, this is USDA. Just didn't throw us a bone on Friday. So it's legging down. And again, we have moved down to that 4.25. Maybe we're going to move down to, 4.15 area. But at those levels, we're really oversold on wheat. Now, I know on the wheat here, it's a protein-driven market. Here is Minneapolis, and the same thing happened on Minneapolis. It really dove down, but again, the Minneapolis around 605 a bushel, right where if I can hold that dot. If you're selling grain here at these levels, and let's say you're getting a pretty good protein premium for it, and you want to reopen your price ceiling, consider some call options. Start getting along. Because the grains in my head, like the equities are like this, the grains are getting absolutely hammered, albeit we can go a bit lower, but we are 90% there. I really can't see much more. Yellow peas in India, new crop yellow pea bids, I believe, are somewhere around $6.25 to $6.50 per bushel for new crop delivery. For the time being, it's going to stay the same. Just going to hold. Nothing, I can't see anything just yet because I think India will keep their duties in place. Canola, have to look at the soybean market. When StatsCan came out with that record-breaking production here about a month ago, and nobody believed, right? What that did, immediately, I remember I had reporters phoning right after that, and what they were asking is, will that allow canola to divorce itself from soybeans? And in all honesty, yes, it will. Because not so much divorce is the word, but what it'll do is it won't allow the canola market to go out on its own. because of that number, because our carryout will be 2.5 million metric tons if StatsCan is right. So that means there's a lot of canola out there. But with that said and done, there's some basis premiums. Again, I'm reflecting more on Alberta, but I'm sure it's maybe the same in Manitoba. There were some good basis premiums the other day in Lloydminster. They were as high as, guys were getting as high as about $11.25 a bushel. Now I realize you all want 12 bucks, but the market's changed on you. And to me, $11 to $11.25 on a basis premium, to me, take it. Take it. I'm not very bullish canola right now, and that's because of the supply. Now, that can change if we get South American weather, but right now what I'm seeing on South America, it's not bad. It's in pretty good shape. So here is, here's the palm oil, and this was right here. This is where India imposed a palm oil duty, and it pushed the soy oil down, which also contributed to pressure on canola. So India was bugging our market indirectly through palm oil. They put a 30% tariff on it. Here's March canola. Right now, 500 is resistance. Right now, 483 is support. So that's our line right there and right there, overall in canola. If we see the market boost up over $500 for some reason, really consider it on old crop. Really start looking at it. Like I'd like to present a really bullish story to you with canola, but just right now, I just don't get a real feel good because if you look at a weekly chart, you'll see a line at 465 on canola. It used to be an old resistance line, and then they break, and then they go higher, and then when the market goes back down, it goes back to its old steps. And I was just talking to Ed White, with the producer, the other day, and said, Ed, that's just like old buffalo trails. The market will break higher to these other levels, and then once it starts to get into a little trouble, it'll go back to its old buffalo trail. And to me, I don't want to say we're going to 465, but if the beans keep dropping, we will. But that's not to say that you won't get a rally between now and March. But if you do, price are up. Price are up. Okay, I'll hustle along here. New crop. Right now, there's real resistance on the NOV, approximately 508, right there. The support on the NOV is around 490. That's the range, as I see it, right here. And until we know more about new crop, it's going to continue to chop through that zone. I don't think there's a major downside on new crop because we don't know. We don't know what growers are going to produce. We don't know the weather. So I'm going to finish off with a quiz. And the reason I'm putting this out here for you is that you are going to get opportunities to price your grain profitably. It will come. It will happen. But you have to be back in your mind. You have to say, hey, these markets are markets. They're going to move around on us. So 4 key market situations that you may be affected with. Strong futures. Futures are zooming up, right? And the buyer's saying, please, 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 please. Basis levels are narrowing. That used to be the wheat market, right, a few months ago? What should you do? Okay, don't say store it, okay? That's the best of both worlds. Sell your cash, But at the heat of a bull market, it's tough to do, right? Because, gosh, George down the street says canola's going to go another $2 higher, It's tough to do, but you got to just step in there and do it. And you know what? If it goes higher, this is what I encourage guys to do. If it goes higher, what we do is we scale and put options on them. And I love that strategy. All I know when the market is flaring is that it's going to break. I don't know where the top is. I have no idea. I don't want to get a client into margin call trouble, so we use puts. And if the puts expire worthless, yahoo, right? If the puts expire worthless, that means the insurance wasn't used, and that means the cash price went sky high. Biggest gains I've ever had with clients are with put options in a rallying market. And everybody is so bullish they can't see straight. just like the stock market right now, right? Get those puts, and you'll be wrong. Get them again, you're still going to be wrong. It's going to keep going higher, and then one day you'll wake up and chunk, and all those ones that you even forgot about at the bottom are starting to fire. We had some, I shouldn't say this, but we had some people with put options on Minneapolis spring wheat, and this past year, and some of them did poorly in that they bought them too soon. Ones that bought up here, they pulled out about $2 a bushel on a put. Like that was, without risk. They just risked the put. So again, that's what I do for a living, so that's why I'm a little bit biased, but I see some success. Strong futures, okay? Futures going up, but the basis levels, the buyer won't return your phone call. What should you do? That is your hedge signal. So that is lock in the futures, right? Buyer won't return your phone call. Basis level is weak. So that's where get some put options. You can, if you're brave, sell the futures. Lock a futures only cash contract. Here's another one. Weak futures. Futures are coming down, but the buyer says, please, please, please. Please, I want it. I know the price is lousy, but I want your grain. Okay, what do? Basis contract. Okay? That's the time to sign your basis contract. Okay? You're getting a narrow basis. But what if you need cash? Okay? Okay, price it. Say, oh, darn it. Pricing at a low of the year. But then, add in some call options. Buy some calls. Reopen your price ceiling. I really like that one too. All these situations you've come through. And the last one is weak futures. Futures are diving down. The basis level of the grain buyer won't return your phone call. What should you do? Farm storage. Time for your grain bins. Now that's easier said than done because you might need more than just farm storage. But I'm just doing the old economics thing on you. But I'm throwing this at you because this is what you're going to have opportunities. And when you see these signals, that's why I do believe that having a commodity account with somebody is useful because it's just another tool in your marketing toolbox. So with that, I'll wrap up. This is what we do for a living. We trade two guys in a log house in Calgary, R.J. O'Brien. And in the afternoon, we write about the market. We call it Pro Market Wire. Thank you very much.
We probably have 2 minutes. If there's any questions for Earl, that would be, we have a couple minutes so we could take those. So.
In lieu of a former speaker saying that they have to make the farmers 55 plus, and all of this information that you provided, what's a 3 to 5 year timeline for exiting strategy?
Yeah. Good question that I can't answer. Yeah, sorry. Yeah. You know what? I'll just summarize this really quick. There's going to be a correction in the stock market, without a doubt. It's coming. And it's going to be more severe than we think. And it could start a recession between 3 to 5 years long. That's the nasty, okay? Now, as far as commodities, though, here's a bit of a breath of fresh air, is that you got this massive bubble on the equities, and you got agriculture that's depressed, going downhill right now. That money has to go somewhere. And you may get a roll effect where that money that's getting, people that are losing a bunch of money on the equity side are saying, well, we got to put it somewhere. We're going to buy some farmland. We're going to do, and when I look at the wheat prices right now, I look at the corn prices, they're dirt cheap. Absolutely dirt cheap. Now, these commodity funds are dead short this market, and they keep shorting it, but you know what? They've spent all their bullets already. These commodity funds, they can't short it anymore because they don't have more money. They're short to the hoot. So when we get up spooked, they're going to buy out. And that will be your pop in the wheat market this spring. Okay? That will be your pop. Probably I'm not speaking in my comfort zone. Land Land's, yeah, I'll spit it out. Land's overvalued, okay? It's overvalued. We're gonna see some form of a correction on land too, because if we see a knockdown in the equities, it'll be like elephants running through a keyhole. It will be. I kid you not. I've seen it. The thing is that in the equity world, people have never been in commodities. People that have been in commodity world see this all the time, like this, right? Equities, they're always babysat by the central banker. And that's such a different mentality. They don't get it until there's a generational kick in the butt, which is going to come to a lot of traders and investors. Yeah, I didn't answer your question, sorry.
Yep.
Oh boy, you're good. I don't know. I can see about that far, huh? I think in the U.S., as far as our relations with the U.S., if there's a disruption in the trade, it's going to be mega hurt down even in the Midwest. Like I can't fathom for a second that, I'm dodging your question, but I can't fathom for a second that NAFTA is going to get ripped up. Not a hope. Not a hope in my view. They can lots of talk, but no walk.
I'm going to take one more quick question from up at the top there, gentleman in the brown.
Yes, it did. The difference, though, is debt. That's what I see. It's a bit of a different beast. I view this debt problem as how to rectify it. Again, this is where you'll probably boo me off the floor here. But to rectify it, it's pennies on the dollar. It's write-offs. That's the only way we can do this. How else can we do it? Other than a world war, which we don't want to talk about, which stimulates the economy. I see the comparison with 1929, but the difference in 1929 is there was no central bankers babysitting the market. The market crashed. And the market should have crashed in 2007. It really should have. And in all honesty, I kind of wish it would have. Because if it would have, we would be restarting. It would be green buds by now. It would be. But you can't get elected saying that. I'd make a terrible politician. Nobody would vote for me. Yeah. Anything else?
I think in the essence of time, Earl, you'll be here for a few minutes at the back.
Absolutely.
Yeah, or just outside the door. Anyway, if you could please join me in thanking Earl Anderson with ProMarket Communications. Thank you.
Thanks for tuning in to the Manitoba Ag Days podcast. We'll see you next year from January 22nd to 24th, 2019.